Good morning, everyone. It's Monday. Welcome to my blog for this week. Let's have a look at what's happening in the market, in company news, and some stock picks, but also something very special. So let's get started. Yes, in this edition, I'm going to look at how we find great stocks. Last week and the week before, we looked at how we do it within the Investment Club network in terms of identifying great quality stocks and great value stocks. This week, we'll look at how Benjamin Graham did it and how he taught Warren Buffett and others how to do it. But first, let's look at what's happening on the official news front. Nothing really until Thursday of this week. On Thursday, we've got advanced GDP, unemployment claims, and pending home sales. All fantastic barometers of how the US economy is doing. On Friday, we get the core PCE price index month on month. That is how consumer prices have increased or decreased without energy or without food. All of these look to be increasing. That's what's worrying the central bank in the States. That's why they want to slow things down a bit, and they want to move the prospect of interest rate reductions further away. And that's why we're getting a fall in stock prices. Company news this week. Meta, they are building up on the AI front, trying to challenge ChatGPT. So we'll see how that progresses. They should have a great start with input from Instagram, WhatsApp, and Facebook. And Paramount, there's still talk of a buyout, and that got the shares to surge 9% last week. Let's see how it pans out. H&R Block, they seem to be hitting rocks in the road quite a bit these days. The latest has been a dropout in service right on the very day when taxes had to be filed. Not very good. They provide services to small businesses and individuals that include tax return filing. It's their core business. And just a little note on Apple. Apple is losing some of its market share. It's now fallen behind Samsung. You can see the figures there. So Samsung now have 20.8% of the market, Apple 17.3%. Perhaps they should bring their exorbitant prices down a bit. There's a lot of earnings. We're coming into earnings season over the next week or two. So be careful. We don't tend to trade stocks where the earnings are due out imminently. If you want to take advantage of earnings, do it when the earnings are announced and catch the overreaction up or down. Overreaction up, good chance to sell stock. Overreaction, the price goes down, good chance to get in at a good price. On the poor market indices this week, what's happening, guys? We now have several weeks of falling figures on the indices. So the collective TICN stocks, all of the 4x4s and stocks that have been 4x4s since the 31st of March 2020, although they have gone up by 126% in price since that time, in the last week they fell 11.3%. We normally expect prices on the TICN stocks to fall by less than the general market and to recover more quickly. This week, we've got a bit of an exception. That said, the S&P 500, although again, it's up 92% since March 2020, it is down 6% last week. The NASDAQ, up 98% since March 2020, down last week 11.59%. The Dow, against the trend, got a slight kick up last week, 76% since the 31st of March 2020 and 0.01% last week. Not great, but quite often the Dow seems to be a harbinger of change in the market. So if we get change in the market with the Dow going up, then we see the others might follow. And I can see a mistake there. The Dow should actually have a green upward facing arrow, not a downward facing red one. So how do TICN, the Investment Club network, evaluate stocks? Well, they have two scores, as we've seen over the last couple of weeks, one for quality and one for what they call price, but actually mean value, whether the stock represents value for money or not. So for quality, industry ranking, that moves around an awful lot and is very dependent on some changes being made in other businesses than the one that's being examined. It's not really very strong yet. However, it does only get a weighting of 1 against the maximum of 3. Then timeliness and safety. These are scores that come from Value Line, and they are very good scores to keep a measure on. We look at the debt, we look at the beta. The beta is what happens to this stock if the general market went up on average by $1, what would this stock go up by? Would it be $1? Would it be more than $1? Would it be less than $1? And also, similarly for falls, if the market went down by an average of $1, what would happen to this stock? So it's how much the stock is affected by the market changes, as opposed to changes within the company that the stock belongs to. And we also look at growth trends. And of course, all important to me in particular, the management. Are they any good? Are they doing what they need to do? Then on value, we turn to dividends, the estimated price appreciation. Sales versus earnings is a reference to sales growth versus earnings growth. We like to see earnings growing at a faster pace than sales. And we also look at the price to earnings ratio and also the reward to risk ratio. So we get 2 scores from all of this, both out of 52. For quality, we want to have a score of at least 30. For value, we want a score of at least 40. So that's how we do it. So Benjamin Graham and his partner, Dodds, how did they do it? And how did they teach Buffett to do it? And how did he go on to do it with Charlie Munger? Well, these are the 10 factors that they were looking at. First of all, current assets versus liabilities. And they want the current assets to be at least twice the current liabilities. So very strong balance sheet. Long-term debt. They want to see long-term debt no more than the net current assets of the business. So if the net current assets of the business were 10 million, then the debt's got to be less than 10 million. Earnings. They wanted to see no losses posted at all in the last 5 years. I'm not sure how that would have stood up to the pandemic and the lockdown. And then earnings per share. They wanted to see a third increase, 33% in the last 10 years. And at the beginning and end of those 10 years, they would use the averages over 3 years. I'm not 100% sure I understand that, but I think it makes sense. Then the share price. They want the share price to be no more than 15 times average earnings over the last 3 years. That's high. I think I'd like to go lower than that. And then the book value. The current price to be no more than 1.5 times book value. I know that Benjamin Graham said 2.5 times. I think 1.5 times is better. Then the price to earnings ratio. They want that to be with over 3 years, and TIC take a 5 years on this. They want the price to earnings ratio times the price divided by the book value ratio to be below 22.5. Whew, that's a calculation. Institutional ownership, they want to see it below 60%. Now, we often take comfort that some of the big guys, Vanguard or BlackRock, actually have a substantial ownership of the business. We feel we're in good company. But what Benjamin Graham was saying is that that can become too much of a good thing. If it's 60% plus, we're probably too late getting into this thing. So, and then dividends. Benjamin Graham said the company must pay dividends. Quite interesting that Berkshire Hathaway, Buffett's main business, doesn't pay dividends. The reason that Benjamin Graham wanted companies to pay dividends was that he looked at the return, and they are part of the return, And he thinks that quite often they needed to have dividends as well as price appreciation to make the stock worth owning. And then popularity. This actually comes from Warren Buffett and Charlie Munger. They like unfashionable or unloved companies. Where there's perhaps been a scandal or a big loss or some other bad news. And once that's passed over, they then find a good time to get in. They also like easily understandable companies in good financial health. And if possible, near monopolies with a good, strong consumer brand. Don't want much, but putting all this lot together, we're getting a great combination of requirements. So here's now what I'm using. Most of it, what I'm using is in here. The value line timeless score, I want it to be at least 3 out of 5. Sorry, that's going to be a 1, a 2, or a 3. 5 is bad on this score. Then we've got our value line safety score, the same, a 1, 2, or 3. And then comes quality. Here I'm using the TICM score. And as I say, I want 30 for that and 40 for value. I want then to turn my attention to the indicators. The stochastics, I want them below 20. The RSA below 30. I'm not as rigid on these two. The risk to reward ratio, I'm looking at as being indicated by where the stock stands in relation to its 52-week low and 52-week high. And I like the stock price to be no more than 35% up from the bottom of that. I want the earnings announcement to be due in no less than 2 weeks. It must be at least 2 weeks. And then price. I'm not keen on stocks that are now less than $5, and really I'm not keen on them over $100 either. The returns that we get on options at that top end are just not brilliant. So these stocks passed all of those tests, but I'm not happy. I've decided to give them some more tests. So here we go. So I've looked at the actual price to earnings ratio. I've let AEO slip through a 25.95 as price to earnings ratio, but I'm not really happy with it. The others I'm much happier with. If we can get them down below about 12, that's brilliant. The middle column there, BVPS, book value per share. So that's what you can buy that's the value of the assets that you're going to get when you own a stock. I then looked at the multiple of that. So that is, if a company was available, let's make it nice and simple, for $100, and that included premises, stock, debt owed, etc., the real, true, actual book value, and the multiple was 2.36, then we'd be paying 236 times the book value to buy a share. And some of them can be really low. This week's are not quite as good as last week's, but we've got one there, AVT. If you buy $100 worth of stock, you'll pay $82 for it. The rest is of this column is me looking at, well, what I think is going to happen to the market this week. And I'm thinking that if it goes down still, it could go another 3%. That's to a really strong point of support. If it did that, and these prices reacted true to their beta score, where would the price end up at the end of this week? And then I said, okay, that's where the price would end up statistically, but let's look at the charts and find a good level of support. And where appropriate, I've used the support level instead of the forecast level. And then the funny little arrows at the end. So in all but 2 cases, these stocks at the end of last week had changed direction. These stocks were beginning to rise completely against the market. The other 2, the top and the bottom, they're AEO and Skechers, they were going sideways. So none of the stocks that I've actually picked out here were actually still falling. That's got to be good. And that's it for this week. Next week, I'm going to look at the months that we choose to sell puts in, and how choosing months that are further out in time can not only affect the return on the trade itself, that's the annualized return on capital employed. It can also affect other trades, future trades, by not leaving capacity available to take advantage of the best trades in the best months. So thanks for listening. I shall see you next week.